Hello, everyone. Thank you for joining our Wealth Approach podcast. I'm joined, as always, by Michael Schneider and Megan Kowalski. This month, we have an interesting topic. I think with the markets running as much as they have over the last couple of years, a lot of portfolios have built up concentrated positions, or many of you might have inherited a concentrated position, and ideas around diversifying or topics like that I think are interesting to consider in this environment.
Yeah, so to touch on a little bit further with the legacy positions or concentrated positions, this can occur from a number of different reasons. One could be you inherited an asset that had a large concentration in specific company. You could be working at a company where a large part of your compensation is through company stock, and that can build up tremendously over a course of time for your portfolio. But typically these are positions where you might have a rather low basis and you've held them for a long time, and they have a large unrealized gain attached to them. The reason why we want to kind of touch on this topic is over time, from a concentration perspective, most of your portfolio could be tied to one, two, depending on how many of these you have within your portfolio, and it could have a higher volatility than you might be comfortable with for your risk tolerance. And then also tax planning and liquidity planning for the future when you're in retirement. Some of these companies you might look at and think they're great, they're going to be good for long-term growth, and that's most likely true. But when you get closer to retirement, Michael can touch on this a little bit more, but you might need to start living off your portfolio from an income perspective. And that's where these concentrated positions can get you in a little bit trouble later on if they're not addressed over time.
That's right, Megan. And, we've got three different strategies we want to talk about today, and we're going to be tying them to right now the three largest companies in the S&P. We've got Microsoft, we've got Apple, and we have NVIDIA. A lot of growth over the last several years, a lot of growth for the first two companies historically. And to kind of tie in, Megan, to what you're saying on it being really on sort of planning for more income in retirement. One other thing all three of these companies have in common is they pay less than a 1% dividend yield. So when you are in retirement, if you do need to live off those investments and you do need to generate income, if you have a position that has a low basis and a large market value, it's really just kind of dead money that really, unless you liquidate and sell it, really can't be included in your portfolio because you're not using it, you're not paying the taxes on it, and it's not really doing much from an income perspective for you. So when we look at the three strategies I want to discuss today, the first is how to really trim positions over time. Really look at it from a scheduled perspective, kind of take the emotion out of it. There are some different option strategies that you can look at to generate some income to offset capital gains, or some more or less ways to utilize other types of losses to offset the gains as well. And then lastly, you can talk about gifting to charity, as give shares as opposed to giving cash. And I know JR's got a famous story about just to kind of put all this in context as well.
Well, Michael, to that point, I mean, when you think about concentrated positions, it's wonderful as they go up. That the challenge is what happens when they go down. And I'm always reminded, many of you have been to our office, and we have our first stock screen from 1974 on our wall. And when you look at that first stock screen, you look at the largest companies in the U.S. markets at the time. Number one was IBM, right? In 1974, IBM was taking over the world. It was growing like crazy. It just continued to do very well. And I'm reminded of a story from our founder, Gene Lerner, that told many times over the years, where he had a client that had a large concentrated position in IBM. And he tried for years to talk to the client about diversifying, the advantages of everything we're talking about today. And the client was very reluctant for years and years. Finally, after a period of time, he called up one day and said, "You can now sell my IBM stock because there's little to no gain left," right? And that's the challenge when you think about, concentrated positions overall. And the interesting thing is, if we were sitting here in 1974 and said, what are the odds that IBM will be number 47 in the S&P 500? At the time, we all would have thought zero, but that's what happened. Today, IBM is number 47 in the S&P. It went from number 1 all the way down to that level. And it's just, I think, a good reminder as we sit here today. Yes, these are the 3 largest companies in the S&P today, but that could change dramatically over time as new technologies, new things, happen in the future. And you want to be mindful of valuing your position today, but looking to the future and protecting and building. I think it's a good reminder with a story like that.
Definitely. Oh, sorry. I think the IBM story illustrates a concept that we take from behavioral finance, which is the endowment effect. And a good analogy with this is your primary residence or your home. So most people, when they're looking to sell their home, they might have a number in mind and their realtor might have another number in mind. But typically the concept is that you value something more once you own it. That concept definitely resonates with concentrated positions, especially because you're going to be following these companies a lot closer than some of the other names in your portfolio, since they are a larger portion. And it's just important to remember when you're looking at these, okay, if you, let's say you had 2.7 million exposure to Microsoft today of your portfolio, would you put that again today at today's levels into your portfolio in Microsoft? Or would you not take that risk? I think that's kind of the concept that you should be referencing every time you're discussing lightening up on these concentrated positions, because although you have built a large concentration in it and it has grown in value, that doesn't necessarily mean that will continue at that rate for moving forward. And that's where we just really encourage diversifying or hedging to help reduce some of the risk for your portfolio. So one way to combat is trimming the position over time. And this just takes a disciplined approach. Once you set a goal of maybe what your target concentration that you like in your portfolio is long-term, setting a goal, however comfortable you are, over a 5-10 year period, taking into consideration the capital gains that you'll have to digest over that period and mapping that out with your advisor and CPA. And there's 2 things to also add to this. So one is to try to do it at the beginning of the year. That way you have 13 to 14 months before you're actually paying the tax bill on that position. And then another idea for this is you could buy treasuries that will stagger out over that period, that will mature or come due when you need the payment for that tax bill on those capital gains. So again, it's just referencing over the long term, making sure you're not falling to the endowment effect where you might be valuing it more just because you own it than what it could be worth long term. And taking that approach where, okay, would I sit here and buy this all over again at today's values? Would I take that risk on? Because that's what risk you have just by owning it outright.
Well, the other thing too on that topic, Megan, look at the volatility of that chart. So if you're entering retirement and look at the end of 2022, you lost almost $700,000 on that one position, right? And what could happen to you is the behavioral, you get nervous and you sell it there. I mean, with hindsight, of course you should have held it because it came back to where it is today, but it's much more difficult decision when you're in the midst of watching it fall. At the time, it looked like it could go lower and lower, and here's where things are. So as far as hedging, taking a little bit along the way, it still is rough in 2022 when it's down, but if you diversify it along the way, you're in a much better overall position.
Right, Jared. I want to add that, when you look back over at least this specific chart, the last 20 years with your initial $100,000 investment, that more or less that 12 to 18 month period, you lost 7 times your initial investment there. But these conversations and the behavioral side of this, it always becomes more difficult when you start having these parabolic periods of growth for these companies, whether it's over if you look at Microsoft over call it the last 4 years or other companies like that. But for each of these charts we're going to go through, you're going to see these similar type of moves. Now, another strategy we talked about was with options. There are really, within this type of scenario with the legacy positions and concentrated positions, there are really 2 things you can do. You can look to generate yield from selling calls, as well as buying protected puts. And JR, can you talk about those a little bit more?
Well, if you think about the calls, Michael, and here on the right, you have Apple stock over the last 10 years, right? Your 100,000 investment is up 10 times. So when you think about selling calls, the risk with selling calls is if the stock price goes up more than where you sold the calls, the stock is called away from you or sold. So it could, number one, generate a little bit of cash flow for you. But number two, it can kind of target the capital gain level you want to sell at. So for example, if you sell a call 20% above where the stock is trading today, and you're fortunate the stock goes up more than 20%, that's great. You will sell some of your stock, and in your mind, you'll have offset the tax payment because you have that 20% increase that you don't have today. So it does afford to help kind of discipline diversification as well. And if the stock stays sideways or goes down, you've generated a little bit of cash flow along the way. And then when you think about the other side, buying puts. So what is a put? A put is basically an insurance policy. So what it does is it can protect the position against the downturn. So for example, if Apple's $170 today, maybe you want to protect the position. I don't want it to go below $150 as an example. So you might buy a put option, which will be protection if the stock goes below $150. Or the other thing it can do is if you plan to sell and it's December, you might buy a put option for January, so that, to Megan's earlier idea, you push that capital gain to the following year, but you're concerned that maybe there'll be some year-end selling or into January. So puts can give you some flexibility to plan around paying taxes as well.
That's right. And, the next chart we're going to look at is for NVIDIA. And we look at that, NVIDIA has been sort of the belle of the ball, you could say, over, call it, the last 18 months. When you look at this chart here for NVIDIA, your $100,000 investment a little over a year ago is now worth a little over $300,000. And, when we also look at ways, sort of tax advantageous ways to get out of these positions, gifting is another method of that. And, when you look at charities or foundations, they usually have a brokerage account that you can send securities to. And, there's really a nice tax benefit to that. Not only are you getting the same benefit or same deduction as if you were giving cash and writing a check, but you're also avoiding the capital gains tax. If you wanted to say make a $10,000 donation and you wanted to use NVIDIA, you sold your $10,000 NVIDIA. Well, after your taxes, you've got $8,000 left. So more or less, you have to sell over $12,000 to kind of net out that $10,000 to NVIDIA, or you could just send the $10,000 of NVIDIA shares to the organization. And these foundations and charities, they pay very little in taxes, so you sort of alleviate both parties from this capital gains tax. But it's again, it's also a nice way to sort of give back, and it's a bit more of a efficient way to do so.
So with that, thinking about this topic overall, I mean, really wanted to give some ideas around what to do. I mean, these are good problems to have in this environment, where you have the fortunate position of having these large positions because they have done so well. Just being mindful of not being the IBM story, right? It's the old story. There's only one way to go when you're number one, and that's down. Right. So using some of these strategies to diversify and be thoughtful over time, because the goal is not to give all of your gains away in taxes. You want to plan efficiently. And with that, I want to thank you for tuning in this month.
Right. Thank you.
Thanks.